5 changes happened to your Social Security and Medicare this year. Some of them were announced quietly. One of them moved a deadline that affects every single retiree in America closer than anyone expected. And if nobody explained what these changes actually mean for your monthly check, your medical costs, and your long-term financial security, you need to watch this entire video before the month is over. Here's the part that most people miss. When the government announces a 2.8% benefit increase, it sounds like good news. And it is, on paper. But what they do not lead with is that Medicare costs jumped nearly 10% at the same time. For millions of retirees, those two numbers collided in January, and the result was a check that looked different than expected, not bigger. For many households, functionally smaller when you account for what was quietly deducted before it ever reached your bank account. Let us go through each change one by one in plain language. Because understanding what actually happened this year and what is now moving toward you in the years ahead is the difference between being prepared and being blindsided. The first change is the one most people heard about. Social Security recipients received the 2.8% cost of living adjustment beginning with January 2026 payments. The Social Security Administration estimated this would add roughly $56 per month to the average retirement benefit, bringing the average monthly check from $2,015 to approximately $2,071. For married couples receiving benefits, the average increase was around $88 per month, raising the combined benefit to about $3,208. On its surface, that sounds like meaningful relief, especially after a period of elevated prices for groceries, utilities, and prescription drugs. But here is where the picture changes. That cost of living adjustment was calculated based on the Consumer Price Index for urban wage earners and clerical workers, a measure that many independent analysts say does not accurately capture what seniors actually spend money on. Housing costs, healthcare, and prescription drugs consume a far larger share of a retired person's budget than they do for a working age adult. And according to an AARP survey conducted last year, 77% of older Americans said that a 3% increase would not be enough to help them keep up with rising prices. 77%. That is not a fringe opinion. That is the lived reality of the majority of people receiving these benefits. The second change is where the math starts to work against you. Medicare Part B premiums, which cover doctor visits, outpatient services, and preventive care, increased by 9.7% in 2026. The standard monthly premium rose from $185 in 2025 to $202.90. That applies to individuals whose 2024 income was $109,000 or less, and to married couples filing jointly with income of $218,000 or less. For most retirees, that is the number that matters. Because here is the mechanism that most people do not fully understand. The Social Security Administration automatically deducts your Medicare Part B premium directly from your monthly benefit before the check is issued. You never see that money. It never touches your account. It comes out first. So when people ask why their January check did not go up by $56, even though the COLA was announced, that is the answer. The Medicare deduction increased by nearly $18 at the same time the benefit increased by $56. The net gain after that deduction was roughly $38 for the average recipient, less than $1.25 per day. And Part B is not the only Medicare cost that rose. The annual deductible for Part B also increased. Hospital costs under Medicare Part A went up. The daily coinsurance rate for extended hospital stays climbed. Some Medicare Advantage and Part D prescription drug plan premiums shifted as well. When you add all of those increases together, a significant portion of retirees found themselves no better off in January than they were in December, and some found themselves paying more out of pocket for care even as their gross benefit technically increased. The third change involves full retirement age, and it matters most for people who have not yet claimed benefits. If you were born in 1959, your full retirement age in 2026 is 66 years and 10 months. If you were born in 1960 or later, your full retirement age is now 67. This is the final step in a scheduled increase that began back in 1983, when Congress gradually raised the age from 65 to 67 over a multi-decade period. That phase-in is now complete. Why does this matter? Because claiming Social Security before you reach full retirement age results in a permanent reduction in your monthly benefit for the rest of your life. You can begin claiming as early as age 62, but doing so at 62 when your full retirement age is 67 reduces your benefit by up to 30% permanently. That is not a temporary penalty. That is a reduction that will follow you for the next 20 or 30 years. On the other side of that equation, every year you delay claiming past your full retirement age up to age 70, your benefit grows by approximately 8%. That is a guaranteed, risk-free return that no investment on the market can reliably match. Knowing your full retirement age precisely is not a technicality. It is a decision that could be worth tens of thousands of dollars over the course of your retirement. The fourth change involves the earnings limit for people who are collecting Social Security but have not yet reached full retirement age and are still working. In 2026, you can earn up to $24,480 without any reduction in your benefits. Once your earnings exceed that threshold, Social Security withholds $1 in benefits for every $2 you earn above the limit. In the specific year you reach full retirement age, a higher limit applies. For 2026, that limit is $65,160 for the months before your birthday, with $1 withheld for every $3 earned above it. Once you reach full retirement age, the earnings test disappears entirely. You can earn any amount without any reduction in benefits. This is information that catches working retirees off guard more often than almost any other rule in the system. Someone picks up part-time work to supplement their income, earns a few $1,000s more than expected, and suddenly discovers that their benefit payments are being reduced. The money that was withheld is not permanently lost. Social Security does recalculate your benefit upward at full retirement age to account for months when payments were reduced due to earnings. But the cash flow disruption in the near term can create real hardship for households operating on thin margins. The fifth change is the one that carries the most weight, and it is one that most people have not had explained to them clearly. The 2026 Social Security and Medicare Trustees Report, released this month, revised the projected insolvency date for Social Security's Retirement Trust Fund to the end of 2032. That is 1 year earlier than projected just 12 months ago. The Congressional Budget Office made the same projection in February. Let that sink in for a moment. 6 years. Social Security's Retirement Trust Fund is now projected to run out of reserves in 6 years. The trustees blame a combination of factors: declining birth rates, reduced immigration, and the effects of recent tax legislation on the revenue flowing into the program. What happens at the point of insolvency is not that Social Security disappears. The program continues. But incoming payroll tax revenue alone would only be sufficient to cover approximately 78% of promised benefits. That means an automatic across-the-board cut. According to the Committee for a Responsible Federal Budget, the average retiree could face a reduction of roughly $500 per month. For a typical dual-income couple, the annual reduction could reach $17,000 or more. 73% of retirees currently depend on Social Security for more than half of their income. 39% depend on it for all of their income. A 22% cut to those households would not be an inconvenience. It would be a financial emergency. And Medicare faces a parallel timeline. The Medicare Hospital Insurance Trust Fund, which covers inpatient hospital stays and skilled nursing care under Part A, is now projected to become insolvent in 2033. At that point, it would be able to cover only 89% of promised benefits, potentially affecting access to care for the more than 70 million Americans currently enrolled in the program. None of this is inevitable. Congress has the legal authority and, according to policy analysts, the economic tools to address these shortfalls. What it has lacked consistently is the political will to act before a deadline forces the issue. The senators who will be elected in November of this year will be sitting in office when Social Security reaches the projected insolvency point. That is not a distant abstraction. That is a concrete and specific political reality. So what do you actually do with this information right now? The first and most important step is to know your own numbers. Go to ssa.gov and log into your personal My Social Security account. You can see your full earnings history, your projected benefit at different claiming ages, and your estimated full retirement age. If you have not reviewed that information recently, do it this week. Errors in earnings records do happen, and the time to correct them is before you claim, not after. Second, understand what you are actually paying for Medicare and why. If your income in 2024 exceeded the standard thresholds, you may be subject to higher Medicare premiums through a surcharge system called IRMAA, the Income-Related Monthly Adjustment Amount. If your income has dropped since 2024 due to retirement, divorce, or death of a spouse, you can file an appeal with the Social Security Administration to have your premiums recalculated based on more recent income. Many people pay higher premiums than they need to simply because they did not know this appeal existed. Third, if you're between the ages of 62 and 70 and have not yet claimed Social Security, do not make that decision based on what someone told you years ago. The rules around full retirement age, survivor benefits, spousal benefits, and delayed retirement credits are layered and interconnected. A decision made without fully understanding how all of those pieces interact can cost you money for the rest of your life. The changes that happened in January were not small adjustments. They were the visible surface of a much larger and more consequential set of pressures building inside the systems that tens of millions of Americans depend on every single day. Knowing what those pressures are and what they mean specifically for your situation is not optional. It is the foundation of every financial decision you will make from here forward. Subscribe to this channel and turn on the notification bell. These systems change every year. The rules that apply to your benefits this January are not the same rules that applied 3 years ago, and they will not be the same rules that apply 3 years from now. The people who stay informed make better decisions, and in retirement, better decisions made early are worth far more than corrections made after the fact.